Treasury yield saw an impressive bounce higher this week, nearing 20 basis points from last Friday's close. And a lot of that happened over the last 24 hours between yesterday and today. And I think right now the momentum we're seeing should continue to see yields go higher and prices go lower for the short term while we get all this news, whether it's between the China and U.S. trade deal, Brexit, the Fed, you name it. There's a lot of good things, positive things happening in the world and the markets, and we're seeing stocks rally, taking back their losses, and bonds are selling off with the idea that that flight to quality bid is no longer there. That may be very short-sighted, and I think at this point we may see this momentum slow as we enter next week. Recall we have a holiday on Monday, so things will be very quiet. And as we get into the next week, things may look to reverse a little bit as the market gets its sea legs back under it. But I think this move up through 175 and 10-year note yield is a big move. But let's wait and see what happens when the dust settles with all these proclamations, so we'll call them, that we're having today. Market volatility, it's been trending lower as yields rise, and that is to be expected. However, on today's move, we did not see volatility decline, and I think a lot of that has to come with the speed of this move. It's been a two-day move that's seen very impressive territory. We've seen prices decline very rapidly. We've seen yields go up very quickly. And when this happens, you tend to see volatility start to shore up a little bit. So again, things went out very firm, very bid in volatility, still hovering right around that 14-day moving average, but not declining, and that's significant. So it obviously tells you that in the speed of this move, maybe some got caught off guard, some bad longs in the bond market, maybe some bad longs in the stock market. And I think at this point, we get to next week, and we should see that start to resume its past trend, which is as yields creep higher, we'll see volatility go lower, at least until we get close to 190, maybe even a little higher. And at that point, vol should turn around as we break outside of the existing range, at least since call it the last 2 months. Lastly, let's talk about the Fed, what they're doing here. Well, the Fed expectations for an October rate cut remain in play. However, we're seeing declines in rate cuts for an additional rate cut later on before the end of the year. So that's significant, I think. We're still seeing about 60-70% odds of a rate cut at the end of this month. However, not seeing those 50%, 60% odds anymore of an additional cut. That's actually declined to about 20. So at this point, the market is starting to cave a little bit, something the Fed has actually wanted it to do, and decline those odds to get it back in line with what the Fed wants, which is possibly one more rate cut this year, and then sort of a wait and see, not a rate cut at the end of this month, and then we have to go next month all of a sudden. So at this point, I think that's a positive for the Fed. Likewise, the Fed is going to resume purchases of bills, about $60 billion a month. That goes kind of under the radar today with all the other news we saw between the U.S. and China and what's happening over in the U.K. and the EU. So that is not actually going to affect the back end of the curve, but it suggests the Fed is willing to act now, as the front end of the curve has been a hot spot and there's been a scarcity of dollars. So at this point, I look at that as really just something to put on the radar, not necessarily something that is going to affect longer term yields. And I think lastly, we do look at China and the U.S. They had come to some partial agreement. Certainly you can see in the stock market that was taken very well, and with the way that the bond market sold off, the fear is no longer there that there's going to be some bad outcome. And we're seeing very similar situation over with the UK and the EU, something else that has been hanging over the market for quite some time. And I think those two things combined have given the market sort of a relief rally here. Also in the bond market, you see a lot of that moving out of the riskless assets back into risk. So we'll call it a risk on trade Friday. But look for things to calm a little bit next week. I don't expect 10-year note treasury yields to continue to ascend the way they have. Doesn't mean they won't go up, but I think we're going to slow that speed a little bit as we start to absorb and watch the data more clearly. Likewise, we get to the end of the month, we get confirmation on all those things, whether it be FOMC, Brexit, we have Lagarde taking over the ECB, and maybe we'll have some more clarity on the China-US trade deal, which from today's talks and today's reporting looks very positive.